All right, let's get into it. Today, we're going to put on our detective hats and crack one of the biggest cases in finance: how to actually pick stocks. We're going to demystify this whole thing, and I'll show you how to think about it not as a gamble, but as a really thrilling investigation.
So, let's be real. Does picking stocks sometimes feel like you're just rolling the dice at a casino? It's a super common fear, right? And honestly, it's a valid one, if you don't have a solid plan. But trust me, there is a much, much better way.
Because here's the big secret. It doesn't have to be a gamble at all. Instead, we're going to approach it like an investigation. You're the detective. You're out there looking for clues, you're building a solid case, and you're going to reach a verdict based on actual evidence.
Okay, so why even bother going through all this trouble? Why play detective? Well, let's open our very first case file, the powerful motivation behind it all. It really boils down to the incredible potential for serious, long-term wealth creation.
Just take a look at this. This is Eicher Motors. Starting way back in 2009, it delivered a mind-blowing compound annual growth rate, we call that CAGR for short, of 104% a year. Now that is not a lucky lottery ticket. That's the result of a fantastic company doing what it does best for years and years. It's exactly the kind of reward a successful investigation can uncover.
So what is this CAGR thing anyway? Think of it as the engine that powers growth on growth. It's the average rate your money grows each year, but it includes the gains from all the previous years. It's pretty simple, really. The higher the CAGR, the faster your wealth was created. It's the magic of compounding, right there in action.
Okay, so every good detective knows you gotta understand what kind of evidence you're looking for. In our investment cases, all the clues really fall into two main categories. You've got the story behind the company, and you've got the hard numbers it puts on the board.
So our investigation has two sides, and you can see them laid out right here. On one side, you have qualitative analysis. That's the story. This is where we dig into the people, their ethics, the company's big competitive edge. And on the other side, you've got quantitative analysis, the numbers. This is all about getting our hands dirty with financial statements and performance data.
And here's the crucial part. You absolutely cannot just focus on one. Great numbers can hide a really terrible story, like, say, unethical management. And a great story without the numbers to back it up, well, that's just a fairy tale. A complete investigation means you have to put both of these pieces of evidence together to see the full picture.
So let's start with the qualitative side, investigating the story. Think of this part as building a really detailed profile of our suspect, to understand its true character.
So, what exactly are we looking for in the story? Well, here's our case file checklist. Who's actually running the show? Are they ethical? I mean, how do they treat smaller shareholders like us? Are there any sketchy insider deals going on? Even the promoter's lifestyle can be a clue. If they're reckless with their own money, how do you think they're going to handle yours? Any red flag here is a good reason to hit pause on the investigation.
Now, one of the most important parts of this whole story is something the legendary investor Warren Buffett calls the economic moat. Just imagine a castle. The moat is what protects it from invaders, right? Well, for a company, its moat is its sustainable competitive advantage, that unique thing that keeps all the competitors away and protects its profits year after year.
This quote from our source really says it all. A strong moat is the absolute key to safeguarding those long-term profits. It's what separates a flash-in-the-pan success from a true long-term wealth creator. And finding that moat is a critical part of our job as detectives.
All right, we've sized up the company's character. Now it's time to make the numbers talk. We're heading into the quantitative side of our investigation now, where we look for the cold, hard facts hidden in the financial statements.
Let's face it, financial reports can look like you're trying to read a foreign language. It's just a wall of text and numbers, and it can be really overwhelming. But just like any code, it can be cracked. The secret is just knowing which clues to look for.
And we can focus our interrogation on three key documents. First up, the profit and loss statement. The big question here, did they actually make money? Second, the balance sheet. This tells us what they own versus what they owe. And third, the cash flow statement. This one is so important because it tracks the actual cash moving in and out of the business, which, believe me, can tell a very different story than profits alone.
Now, with all this data, is there like a quick diagnostic test we can run? A simple way to take a company's financial temperature and just check for signs of stress? Oh, you bet there is.
It's called the debt-to-equity ratio, and it is such a powerful clue. It simply compares how much money the company has borrowed to how much money its owners have actually invested.
It's a direct measure of how much risk it's taking on.
For example, our source material looked at a company with a ratio of 1.69. So what does that mean? It means for every single dollar of its own capital, the company had borrowed almost $1.70. Now, there's no single bad number here, but a ratio this high is definitely a signal to us detectives that we need to investigate the risk much, much more closely.
Okay, so we've analyzed the story. We've decoded the numbers. We've gathered all our clues. Now comes the final, absolutely critical step in our process, reaching a verdict. Do we invest, or do we pack up and move on to the next case?
But before we deliver that verdict, every good detective needs one last principle. It's called the margin of safety. The idea is really simple. After you've done all your work and estimated what a company is truly worth, its real value, you only buy it if the market is offering it to you at a big discount. This is your buffer, your safety net, just in case your investigation missed something.
And this really gets to the heart of it all. Identifying a fantastic company is only half the battle. Your investigation isn't complete until you figure out the right price. You have to remember this: a wonderful business bought at a crazy, inflated price can still be a terrible investment.
You see, at the end of the day, becoming a successful investor isn't about one giant leap of faith or some lucky guess. It's about taking these methodical steps one by one. You build your case, you check your facts, and you make a decision based on real evidence. And the reward isn't just financial. It's the confidence that comes from a job well done.
So, now you've got the detective's toolkit. You know how to investigate the story and the numbers, and how to make a final verdict with a margin of safety. The question isn't if you can do this, it's what story are you gonna uncover first?